Hi everyone. My name is Diana Oreto. I run research and the Global Standards Mapping Initiative at GBBC. We have run a working group on digital money and payments, and it is my pleasure today to be joined with our co-chairs Rahul Advani from Ripple and Wee Kee Toh from JP Morgan Kinexys, where we will discuss the report and landscape that we have put together, as well as latest trends on standards for digital payments, digital money and payments, which are a huge trend and opportunity in the blockchain and digital asset space today. We are so grateful for your contributions to this work, and I will let Rahul and Wee Kee introduce themselves briefly. Please tell us your role and your main area of focus. So Rahul, please get us started.
Thanks, Diana, and it's a pleasure to be here. My name is Rahul Advani. I'm based in Singapore, and I'm the global co-head of policy at Ripple. Ripple, as you may know, provides blockchain-based enterprise solutions across payments, custody, liquidity, and treasury management, leveraging the digital asset XRP and the stablecoin RLUSD to help institutions operate and scale in the modern financial system.
Wee Kee, please introduce yourself.
Thanks, Diana. Hi, everyone. So I'm Wee Kee. I'm based in New York from Kinexys by JP Morgan. So we look at all things blockchain within JP Morgan. We run a live blockchain-based networks today. We transact about $5 billion in value every day. And we also recently issued deposit tokens on a public blockchain. So for me specifically, I look at business architecture, and a large part of that is really working with the industry on some of these new initiatives. So very happy to have worked with Diana, Rahul, and the broader team over the last many months on this set of really important work. Thank you.
So the reason we are here is because there's so much opportunity today with digital money, and we have to come together to do it right. And who better than stakeholders like yourselves? Together, we have produced a comprehensive evaluation that maps out the evolving landscape of blockchain-based digital money, where we focus on stablecoins, deposit tokens, and CBDCs, with the majority of our focus on the first two. We have defined key operating models, stakeholders and roles, use cases, and most importantly, the journey of making a payment with blockchain-based digital money. We've framed how these digital money payment processes converge with traditional payment systems under regulatory and standards frameworks with an end-to-end view of a digital money payment ecosystem. And it's been a wonderful journey to work with both of you. So let's get our discussion started on the forms of digital money. And as we are going into a world where there will be several forms of digital money, starting with Rahul, what are the similarities and differences between stablecoins and deposit tokens as forms of digital money? And how do you see those innovations taking place in Singapore? And if you can walk us through some use cases as well, that would be great.
Sure, Diana. And this is a question I find genuinely interesting because stablecoins and deposit tokens are often treated as competing instruments when they're more accurately understood as complementary, serving overlapping but distinct needs with meaningfully different legal and operational architectures underneath. So the similarities are quite real and very important. Both are blockchain-based representations of fiat value. Both aim to maintain a stable 1:1 relationship with a reference fiat currency. Both support programmability, so that's the ability to embed payment logic, conditions, and automation into the token itself, which is something neither cash nor traditional bank transfers can do. And both are being explored for the same high-value use cases: cross-border payments, trade finance, treasury management, and tokenized asset settlement. The differences, however, are structural. The most fundamental is the issuer type and the resulting liability structure. So a stablecoin is issued by a private entity, for example, a company like Ripple, the issuer for RLUSD, and the liability sits with that issuer. When it comes to deposit tokens, they're issued by a licensed depository institution, and the liability sits within the existing banking regulatory perimeter, including deposit insurance frameworks and prudential supervision. This matters enormously for institutional counterparties who need to know what they're holding from a balance sheet and risk management perspective. The second key difference is transferability and network reach. Stablecoins are typically transferable across wallets and counterparties on public or permissioned blockchains without restriction to a single institution's ecosystem. Deposit tokens by design are claims on a specific issuing bank, which means that interoperability across institutions requires either technical bridging or common platform agreements that don't yet exist at scale. And third, stablecoins have a fairly developed retail and consumer-facing track record. They're already being used for remittances and cross-border payments today. Deposit tokens are almost entirely institutional today. How this is taking shape in Singapore is a particularly useful lens because Singapore has, in my view, one of the most thoughtful and architecturally coherent regulatory approaches to digital money in the world. On the stablecoin side, MAS finalized its single currency stablecoin framework, creating an MAS-regulated stablecoin label for stablecoins pegged to the Singapore dollar and G10 currencies that are issued in Singapore. This label enables users to readily distinguish MAS-regulated stablecoins from other digital payment tokens, including stablecoins which are not subject to MAS's stablecoin regulatory framework. And we expect to see the legislative changes for this framework in the near future. And this isn't just about consumer protection. It's about creating a recognized, trusted instrument that can serve as a reliable payment infrastructure in Singapore's role as a regional financial hub. The stringent reserve, capital, and disclosure requirements to earn that label are the right threshold for institutional confidence. On the deposit token side, Singapore is exploring these under the existing Banking Act framework, treating them as distinct from non-bank issued stablecoins. The interesting nuance is that deposit tokens may also fall within the ambit of digital payment tokens under the Payment Services Act, depending on how they're structured. In terms of use cases, I think Project Guardian, which is an MAS-led initiative with major financial institutions, is the clearest live example of Singapore operationalizing these instruments together. It's tested stablecoins and tokenized deposits as the money legs in tokenized asset transactions, essentially building the infrastructure for a multi-rail digital money ecosystem in a live regulated environment. Another MES initiative is Bloom, which stands for Borderless Liquid Open Online Multi-Currency, where MES is collaborating with the industry to enable settlement in tokenized bank liabilities and well-regulated stablecoins. And Ripple is a participant in Bloom. So stablecoins and deposit tokens play very similar roles. For stablecoins, the most compelling use case is as a settlement currency for trade and remittances. The region has significant payment friction. You've got multiple currencies, inconsistent correspondent banking relationships, high remittance costs. A stablecoin that can move instantly across wallets on a shared blockchain network eliminates multiple intermediary steps and dramatically reduces both cost and settlement time. And Ripple's work in cross-border payments in the Asia-Pacific corridor speaks directly to this. For deposit tokens, the clearest near-term use cases are institutional, automated corporate treasury management, where smart contracts sweep cash between subsidiaries in real time across time zones, trade finance, where payment release can be conditionally linked on-chain to the delivery of shipping documents, and tokenized security settlement, where the deposit token provides a cash leg for atomic settlement of a bond or an equity token. I think where the two instruments genuinely converge is in use cases in serving as a cash or settlement layer for tokenized real-world assets. That's a market that is projected to reach 19 trillion by 2030. Whether the cash leg in a tokenized bond settlement is a stablecoin or a deposit token will depend on the counterparties involved, the regulatory perimeter, and the blockchain network, which is why interoperability between them is so critical.
Fantastic overview, Rahul. This should be available to anyone who's thinking strategically about institutional adoption, stablecoins or deposit tokens, and how do we think through this. Moving to Wee Kee, of similar experience and wisdom in this space. Building on the themes that Rahul raised just now, how does Kinexys by JP Morgan see these innovations evolving in the near term and in the longer future?
Well, when we think about the immediate term, I would say that there is still some obstacles, and live usage is really that big hump that we need to get over. So Rahul talked about retail usage and live and institutional usage. We do see that there has been growth in the retail space in terms of people learning how to use some of these newer forms of like tokens and tokenized payments. But when we look at the more corporate institutional space, I think a lot of institutions are still not ready to use these tokens, let alone issue them. So I do believe that's the biggest hurdle, which is really getting everyone to really understand the space, learn how to deal with blockchain technology, learn how to use tokens, learn how to build wallet infrastructures so that they are able to handle tokens, not just for themselves from a more institutional perspective, but also for their clients. Now, that's really the immediate hurdle. But I do feel that once we're able to pass that hurdle, it's going to be all about scaling. So the future that I see is really institutions issuing different tokens. We're going to go into this world where most of the financial instruments that we are seeing today are going to be in a token form. Now, once you have them in a token form on a common blockchain network or on interoperable network, the next immediate thing is composability of these different tokens. So simplest example, I could be issuing a payment token, a deposit token. Someone else could be issuing tokenized asset. We will be able to allow our smart contracts to be composable. You get atomic settlement, reducing settlement risk significantly. So that's really one of the big use cases. But beyond just that, we'll start looking at other use cases like trade finance, potentially even insurance. How do you start building some of these business use cases into smart contracts? How do you then make use of payment tokens as an ability to immediately make payments when certain things happen or when certain conditions are actually fulfilled? So that's going to be that much longer term future. We're going to see a world where we have all of these different tokens issued by different financial institutions. And because of that, we're going to see much tighter integration of financial services across all of these different parties.
And I'm hearing it's not about treating blockchain-based digital money more of a siloed innovation, but we're really starting to see a trend of systematically integrating it within existing payment flows and processes. And this is an interesting time to give institutional stakeholders a really comprehensive framework to understand things like interoperability, settlement flows, compliance points, architectural integration, and so many of the concepts that you introduced in the report, Wee Kee. One of the report's main themes I want to raise here as we continue our discussion is the convergence between ledger-based digital money and traditional payments that, again, Wee Kee, you stressed very much through your JP Morgan Kinexys experience. As regulatory and risk frameworks mature, there is a clear convergence in processes. And we also see new forms of digital money adding value in areas where traditional cross-border rails have struggled, for example, emerging markets. So I'll turn it first to Rahul again to set the stage and Wee Kee to build on this. But Rahul, what does convergence of payments processes look like in practice? And where is it most evident today? How do you see new forms of digital money creating new opportunities?
That's absolutely correct, Dan. And I want to build on what Wee Kee just described and be concrete about where it's happening and where it quite isn't yet. I think in practice, convergence means that the operational checklist for a blockchain-based payment is increasingly the same checklist as for a traditional payment. So if you think about it, you onboard the user with KYC, you screen against sanctions lists, you verify the payment instruction, you validate and authorize the transfer, you clear and settle the payment, reconcile and confirm receipt, and then you handle any exceptions and returns, right? Those 7 stages apply in essentially the same way, whether the underlying rail is Swift, whether it's ACH, or whether it's a blockchain-based rail. I think the difference is in who does each step, what technology executes it, and in some cases, the sequence or timing. I think the most evidence convergence today is in messaging and data standards. So ISO 20022 has become the common language of institutional payments globally. And its global adoption means that it's a de facto standard for structured payment data. Now, when blockchain-based payment solutions connect to ISO 20022 compliance systems through API gateways or interoperability middleware, that data handshake is clean. Another example is IVMS 101, the Inter-VAS messaging standard for travel rule compliance. It's explicitly designed to carry the same originator and beneficiary data that FATF requires for traditional wire transfers in a format that's suitable for blockchain-based transfers between VASPs. Another area is institutional custody. We're seeing genuine convergence over there. Traditional custodians are now offering digital asset custody alongside traditional securities custody. The controls, the audit requirements, the operational standards that they are applying are drawn from their existing custody frameworks. So it's the same institution, the same compliance culture, the same risk management standards, but being applied to a new asset class. I think the AML and KYC onboarding process has also converged substantially. Whether you're opening a traditional bank account or an account with a regulated VASP, you're going through the same identity verification steps. The technology stack may differ. You might have blockchain analytic tools like Chainalysis or Elliptic sitting alongside traditional transaction monitoring systems, but the regulatory obligations and operational workflow are essentially the same. I think where convergence creates genuinely new opportunities is in the spaces where traditional rails have had hard constraints that blockchain rails can resolve. I think settlement timing is the most significant. Traditional payment systems operate on batch settlement cycles. So you're talking about T+1, you're talking about T+2, sometimes same day, but not always. Blockchain-based atomic settlement eliminates this lag entirely. The cash and asset legs of a transaction settle simultaneously with finality at any time of day or night. For corporate treasury, that means that capital that was previously trapped in settlement float can be deployed productively. For cross-border payments, it eliminates overnight funding costs associated with pre-positioning liquidity in correspondent banking accounts. Programmability is the second major new opportunity. The ability to embed conditional logic directly into money. So release payment when delivery is confirmed, automatically sweep idle cash into yield-generating instruments, distribute payroll on-chain with jurisdiction-specific tax withholding built into the contract. That doesn't exist in traditional payment infrastructure today. This isn't just incremental improvement, it's a brand new category of financial functionality that you're introducing. And the last is 24/7 operation. Traditional payment systems have operating hours, maintenance windows, settlement cutoffs. Blockchain networks operate continuously. For global businesses operating across time zones, the ability to execute treasury operations at any hour without waiting for a payment window to open is genuinely valuable.
And as we can see from Wee Kee, from your experience, we're seeing how major financial institutions are taking this for real, and JP Morgan has been one of the major adopters. As we've mapped together the existing processes to new digital money flows and identified new issues like analyzing blockchain addresses, what do we really deal with when payments are carried out with tokens? What's similar and what's different from traditional payments, and where are the biggest opportunities yet to be unlocked?
Well, I would say that there's probably a lot more similarities than differences, though some of the differences are actually the one that we end up spending most of our time on. So let's first talk about the similarities. So if you look at it, ultimately, we are all financial institutions. I think in most places, whether you are a stablecoin issuer or whether you are a virtual asset service provider, you are coming in under financial regulations and you are treated as financial institutions. So from that perspective, we are all bound by a certain set of regulations set down by the regulators. Now, from a regulator's perspective, they are always looking at risk. When we talk about payments, whether it's payments using tokens or payments using more traditional banking, many of the risks are actually very similar, at least the categories of risk. So we'll think about like fraud, money laundering, illicit finance. Those are the same issues that we face in traditional payments as well as in token-based payments. So from that perspective, processes are fairly similar. Now, Rahul mentioned IVMS 101. If you think about that, actually that's ultimately to fulfill travel rule requirements. So IBMS 101 is a standard used by VAS to share messages between each other. Now, if you think about financial institutions, we use something called PAX 08, which is essentially one of the standards under ISO 20022 to again share payment information between financial institutions. So from that perspective, ultimately the processes are very similar. There are some of these differences here and there in terms of like what's the message format that we use, what's the level of information that we pass to each other. But I would say ultimately the processes are very similar. Similarly, we all do analysis relating to ultimately, like say money laundering. How do we know whether what are the risks of money laundering, what are the risks that this is a fraudulent transaction? We all have our own different internal systems that are used to review, perform analyses, and understand whether there are chances of this. And then when we detect that potentially there are bad things happening, we have processes in place to stop them. Now let's talk a bit about the differences. So the first thing is the underlying system itself is very different. And actually, when it comes to this, I will point to another set of work and report that's been published by the GBBC. There's a risk mitigation framework on the use of public blockchain. I found that to be really useful because that gives us an understanding of some of the different considerations when we are using a public blockchain versus a more centralized system and how we actually deal with those risks. But let's talk a bit more specific. So we talk about some of those things around like money laundering analytics. So from a typical ML perspective, we will perform some internal analysis. Now, when it comes to actually public blockchains, we also have to start monitoring blockchain addresses. So we do face some of these new issues as well. So what happens when we receive unsolicited tokens in our wallet address? Because the same wallet address that I'm using for JPMD, for example, that same wallet address is actually usable for other tokens as well. And not just other tokens, but on other EVM-based networks as well. So you have this concept where, yes, I have a single blockchain address, but my blockchain address could be used for many different things. So from a financial institution's perspective, we start imposing certain internal processes of like monitoring, are we getting tokens in our blockchain address, not just on our own network, but on other different networks. So these are some of the processes that financial institutions typically will have to implement internally once they start looking at use of public blockchain. Some of the other questions that we sometimes face are, will our transactions get processed immediately? Because in a traditional payment system, you initiate a transfer, you have sufficient liquidity, transaction get processed almost immediately. So on the public blockchain, there's now this additional concept of gas fees. Are we paying sufficient gas fees? If we don't pay sufficient gas fees, will our transaction get held for longer? So these are some of the new concepts that actually come about when we are using public blockchains. And these are all concepts that institutions need to understand so that they are able to transact effectively on a public blockchain. We talk about opportunities as well. Like I was mentioning earlier, I do believe that the strongest opportunity is in composability. The idea that if I were to issue payment tokens, the payment tokens can be used for multiple different purposes. And this is where token standards are incredibly important, because if you're all going to issue tokens with different standards, then we are not going to have very good composability, because every time someone were to build a new smart contract to perform certain business use case, they have to cater for all the different types of payment tokens. But this is where I think the industry is still doing a fairly good job, because we are generally issuing payment tokens all to a similar ERC20 standard. So from a transfer function perspective, that's very common. So most of the time, if you're building a business use case smart contract, you know exactly how you'll deal with payments, regardless of what type of payment tokens you are using.
Couldn't be better said, Wee Kee. And through this journey of essentially many of our GBBC resources, including the risk mitigation framework and all of our collective thinking on digital money and payments, we hope to provide tools to be a resource to help make informed strategic decisions around stablecoin, CBDC, or tokenized deposit adoption. This has direct implications for things like liquidity management, treasury operations, cross-border settlement, custody services, and many, many more. But we hope to provide guiding considerations also for institutional product expansion and competitive positioning in regulated markets. So moving on to regulatory considerations and regulatory frameworks, especially given that regulatory clarity can unlock a lot of these opportunities, and otherwise the lack of regulatory clarity can be a significant barrier to growth in the space. Regulatory frameworks, as we've discussed as a group, for stablecoins and overall digital money have varied widely across jurisdictions. It's just the reality that we live in today. And I'm going to start again with Wee Kee. What are the most critical regulatory gaps that need to be addressed to support reliable scale? And how can industry and policymakers work together toward this goal? Because it will be a win-win for all. And finally, do you believe that a global stablecoin will be possible? And what are the challenges for institutions in order to get there?
Well, from a regulatory gap perspective, is mostly what you have mentioned. I think the most important thing is really clarity from a regulatory perspective. The world has moved much in the last couple of years. So if you're talking about this a couple of years ago, we'll probably say that we need a stablecoin regulation, we need a regulation on VAS. But I would say that today in most of the jurisdictions, at least the major economies, we do already have some form of regulations for stablecoins, for virtual asset service providers. So in that sense, clarity has, I guess we do have a lot more clarity from a regulatory perspective. Now, the next big challenge that we have is twofold. One is that this is still really from most of the major economies' perspective, but ultimately, when we look at, say, use of stablecoin, new forms of payment tokens, a lot of times they are relating to, say, emerging economies. So that's where we still have certain challenges. So that's one. The next is really in terms of regulatory alignment. Are the regulations compatible with each other? So here's where I would really want to point out one thing, which is the whole idea of a global stablecoin. Now, one of the work that I used to, so just for context, I was previously at the Monetary Authority of Singapore and also at the Bank for International Settlement. That's a number of years ago. One of the first things that I worked on was on this paper with Financial Stability Board on global stablecoins. So even this was probably about 7-8 years ago, and even then there was this idea of a global stablecoin. But if we look at how regulations for stablecoin have evolved, I'm actually wondering whether that idea of a global stablecoin is still viable, because if you look at stablecoin regulations in most of these major jurisdictions, all of them are very against foreign issued stablecoin. This is coming out very evidently in Europe, where they are essentially saying that yes, stablecoin fungibility is really important, but if you want to have stablecoin circulating in our jurisdiction, it has to be first issued by an entity that's based in our jurisdiction. The reserves have to be held in our jurisdiction, and it has to be governed by laws of our jurisdiction. So if anything were to ever happen, it has to go to courts in our jurisdiction. So you start to see that in all of these regulations, in all the different jurisdictions, there's a big focus on it has to be in our jurisdiction. Now, as long as we start thinking about things from the perspective of our jurisdiction, then it is going to be really hard for any of these tokens to be truly global in nature. So eventually, we do feel that what we are thinking about from like tokens, stablecoins perspective, it will start looking very much like a banking group where you start having entities set up in all the different jurisdictions to issue tokens in those jurisdictions itself. So that's really the point where we talk about a lot of these efficiency gains from a global settlement perspective. But is it truly going to be that global, or are we still going to have a lot of different back-end mechanisms just to enable settlement wherever a transaction or a token actually crosses borders? So that's going to be one of those key challenges that we will face.
Exactly. And points to the importance of interoperability, harmonization, standards and regulations, and many other important topics that as an industry we are considering. Going to Rahul, if regulatory uncertainty is the greatest barrier to institutional adoption and scale, walk us through the latest thinking from regulators in order to get to a better place, to get to that place of harmonization, common ground, and better interoperability. What are regulators currently in a position to do to be able to unlock the benefits of stablecoins, especially when it comes to enabling greater fungibility, which is a topic that you've advocated a lot through the course of the working group?
Yeah, I think, as Wee Kee has alluded to, regulatory uncertainty has unquestionably been the dominant constraint on institutional adoption in the past. However, the change in the past 12 to 18 months has been substantial. I want to be genuinely optimistic. Yeah, I try to be an optimist. It's hard sometimes, but it's also important to be honest about what still needs to happen. So just to take a step back, I think, the Genius Act in the United States is probably the most significant development that we've seen. For years, the US had a fragmented patchwork of state level money transmission licenses and no federal framework that gave a stablecoin issuer a clear path to legal certainty. The Genius Act changes that fundamentally. It creates a federal licensing framework for permitted payment stablecoin issuers, mandates 100% reserve backing in high quality liquid assets, requires monthly third party attestations, and gives both federal and state regulators clear supervisory mandates. For Ripple, this is directly relevant. It provides a legal clarity that allows compliant issuers like us to build institutional products with confidence. The signal it sends to banks, asset managers, and corporates considering stablecoin adoption is equally important. This is not a gray area anymore. You know what the rules of the road are. MiCA in the EU has been live for stablecoin since mid 2024, and its architecture is quite instructive for what comprehensive regulation could look like. The two category framework, so e-money tokens pegged to a single fiat currency and asset reference tokens backed by other assets, creates regulatory clarity for issuers and users alike. MiCA is also notable for what it does within the EU. An issuer authorized in one member state can passport across the EU. And then coming to Singapore, MES's framework for single currency stablecoins is, in my opinion, one of the clearest examples outside of the US and the EU of a regulator creating a trusted, recognized label for compliant stablecoins. The MES regulated stablecoin designation is meaningful because it's backed by stringent reserve and capital requirements. Issuers can't just claim the label, they have to earn it. What regulators are now in a position to do to unlock greater fungibility for cross-border use of stablecoins is some form of mutual recognition. And I think mutual recognition agreements will be critical in this regard. The logical next step from each jurisdiction having its own licensing framework is those frameworks recognizing each other's compliant issuers. So if a stablecoin issuer is fully licensed under the Genius Act or MiCA or MES's SCS framework, they should not face a separate licensing process in each jurisdiction to offer their stablecoin to users. This requires regulators to agree on minimum equivalent standards, so minimum reserve requirements, audit standards, redemption rights, and then to accept each other's supervision as being sufficient. Progress here would be the single biggest unlock for cross-border stablecoin utility. The alternative, as Wee Kee has alluded to, is a world where every payment corridor requires a locally issued stablecoin, which multiplies fragmentation rather than reducing it. I think the broader principle is important to note over here. Regulators are most powerful not when they restrict, but when they create the conditions for trust. Clear licensing frameworks, reserve requirements, audit standards, and redemption rights create the trust that institutions need to adopt these instruments at scale. Every major jurisdiction that has moved in this direction has seen institutional interest accelerate as a result.
Thank you so much to both Rahul and Wee Kee for this wonderfully insightful time with us. It has been such a pleasure over time to produce under your leadership and with the working group's collaboration, a set of institutional grade payments analyses, regulatory and standards linkages, and actionable insight for product and compliance teams dealing with these innovations in digital money to provide strategic foresight from your experiences. We have to close the webinar now. I wish we had more time, but I do want to ask you each a short question to provide us with a key takeaway. And if I can give you one word each, what will be the greatest impact of digital money as it reaches scale? If you can summarize it into one word, that would be great.
Happy to start. Integration.
Integration, that's a good one.
I would say interoperability. I think everything we've discussed today, convergence between ledger-based and traditional systems, cross-border payments that actually work for emerging markets, stablecoins and deposit tokens and CBDCs coexisting in a multi-rail world, none of that is achievable without interoperability.
Excellent. That's so important. And we've got some convergence and consensus in your respective answers to get to a place where we have digital money that works globally and for everyone, for the benefit of everyone. We're going to close the webinar now. Thank you again to Wee Kee and Rahul, not just for your insightful discussion today, but for all the work you've put over the many, many months before to produce the report and all the resources where we've been guided by your inputs and your experience. It's been a pleasure to work with both of you, and I wish you the best.